I will get this call rolling, just so that we can be respectful of everyone's time. If y'all are, I guess if you don't know me, my name is Carolyn Bauerschlag. I am a real estate agent here at Keller Williams Premier. I have been with the brokerage almost 6 years. Super hard to believe. Feels like it's been not that long. I am a CPA by trade. I came out of an accounting background and really didn't care to sit behind a computer only. And what the kind of way I've built my business over the last 6 years has been to be the fiduciary, or the voice of financial reason while we're transacting with clients, right? So many times I feel like the conversation moves into what people want, or it gets emotional, or it's just it starts to really veer away from the true purpose of, I think, what we're endeavoring to do, which is to help sellers maximize the proceeds from the sales of their home, and to also help buyers then find a home that not only is a great place for them to live, that checks all of the yay boxes, but also is something that will appreciate as a part of their overall portfolio, right? And I feel like that's something that gets lost a lot in this conversation, is that real estate is one of the single best assets, asset classes across anything that you can buy, that appreciates over time. Okay, and so what things have kind of moved towards for me personally in the last year has been for us to really focus on, like my husband and I, Andy and I, to really focus on how to build our own wealth through real estate, and both growing the business, but also investing in specific pieces of real estate beyond our primary residence. That of course is not a whole lot different than what I've been consulting people on for the last 5 years, really. So really in the last year, Andy and I got brave and we put our toe in the investment pool. But prior to that, I'd really built a large business around, yes, helping people sell, yes, helping people buy, or scaling up or scaling down or retiring or moving, but really a large chunk of my business year over year over year was investor business. And so that's kind of where this conversation is born out of. Mary, our MCA, approached me a couple of weeks ago, and she said, hey, would you be willing to do what we're kind of doing for KWYP, Keller Williams Young Professionals, and also what we're doing. I've got a profit mastermind that I started to just try to help agents understand the value and the opportunity that they have in their very own hands. So I'd invite you to join our profit mastermind after this call is over, so that we can keep an ongoing sort of dialogue and hold ourselves accountable to the growth that we're seeking. So the way that I kind of wanted to handle this today is to introduce a couple of ideas, very broad ideas that help move you from the mindset of dealing only an income in and income out, and moving you more towards a net wealth mindset. So I want to cover that, answer any questions that you have, and then kind of shift the conversation towards what it looks like to really grow your own wealth as a business owner. I am not a tax accountant, but I know enough. And one of the big things that I want to cover in the second part is getting you out of another mindset, which is that as an individual business owner, your primary goal in this world is to reduce your taxable income to zero. That's a myth. That's a myth, and it can often shoot you in the foot in the realm of you trying to grow your own wealth through real estate. Okay, so that's something that I want to touch on briefly. And then after that, I brought my income statement from 2019. It's just a template. I kind of zeroed out a lot of the numbers. I just put basic numbers in there. But I'm going to walk you through some of it so that you can see what I'm talking about specifically when I say our primary goal is not to reduce your business income to zero, because that prevents you from doing the very thing that you say that you're endeavoring to do, which is to grow your wealth through real estate. The last part that I'd like to do is answer any questions that you have, and for this to be an open dialogue. If you hear my answer a couple of times that I'm unqualified to answer that, then I would refer you to a tax accountant. And the tax accountant that I trust, I'm happy to share his name. I came about him through two different resources in my life. One of them was Bob Pollard here in our office. So with that, here are my two ideas. If you think about your life in terms of your income, everything that you earn, and everything that you spend, what you're describing is an income statement. And the income statement, from an accounting perspective, is only representative of a moment. It's only representative of a single year. And what most people do, and it's a great place to start, but what most people do and where most people get stuck is they say, I make X number of dollars, and then I'm going to spend slightly less than that number of dollars. And then the rest of the money that I have is play money or savings or whatever. But people usually think about it very narrowly, and what can I afford this month? The income statement is a moment of your life. It's a year of your life. And what I want to ask is, what would happen if we thought about our lives in terms of it being a balance sheet? And a balance sheet, what a balance sheet is everything that you own, the total dollar value of everything that you own, minus the total dollar value of everything that you owe. And then what's left over is your equity. Or put a different way, what's left over is your net wealth. Right? So it's the savings, it's the true wealth position that you have as an individual to push your business and your life and your ability to not have to work every single year forward. So if we think about what work is, what we do every single day is for the purpose of generating an income. And I would imagine that some of us someday will look up and say, I'm tired of this, right? Like, does anyone on this call want to work forever? I would personally like to not really work the same way that I'm working for the next 10 years. I mean, I could probably do it for a decade and really be into it, but I would probably want to ratchet back, or at least have the option to ratchet back the level at which I might be working, right? And so if you think about that, and we think about the income statement, if your income stops but your expenses don't, then you don't have money, right? Unless you've really taken the time to consider that your savings are your true equity, which is on the balance sheet side of the statement. So if we kind of just take a moment and think about this, your income statement is one thing, and your balance sheet is another, and every single year, your income, whatever's left over after your expenses, attaches to your balance sheet, and everything that you keep every single year keeps attaching to your balance sheet, such that you have a big fat stack of assets at the end of it. Does that make sense? Would anyone like to talk to me? It'd be nice if I could talk to somebody. Nobody wants to talk to me.
Yes, it makes sense.
Yeah, I think what you're describing is a financial statement that people should probably do at least every 5 years, if not every year, just so that you can see whether your life choices are serving you. That's
right. That's right. So that's the biggest idea. So like a lot of my network is self-employed, and I'll have people reach out to me and they'll say, hey, do you think that I can afford X, Y, or Z? And they start talking to me in terms of monthly payment only. And they say, well, my income went up, and so I'd really like to lease this car, I'd like to rent this apartment, or I'd like to buy this bag, or whatever. You know, do you think I should do it, or do you think I shouldn't? And I said, well, that's just one part of the conversation. You know, your monthly income against your monthly expenses doesn't solve the long-term question, which is, how do you build enough net wealth, or your assets minus your liabilities, that equal your equity, such that you don't have to continue working? You know, and so the hell-bent mission that my beloved husband and I are on are to build is to build as much net wealth as possible so that we are not responsible for generating our own income every single year for the rest of our lives, right? Because if you have investments and those investments spin off income in the form of dividends, if you have stocks, or in the form of interest if you own bonds, or in the form of rental payments if you own investment property, that's all income that comes to you that you were not personally responsible for generating by working a job or owning your business, right? And so when you come to a decision point in your life as an agent, and you say, you know, can I afford this, or should I do this? The question that I really want you to ask yourself is, does making this choice help move me closer to a net wealth goal, or does it move me further away from building long-term net wealth? So if you have to go get a car, because we all need cars break. If you have to go get a car, and that car is going to cost you $500 a month, but you can have an income that supports it, but what's the total debt attached to that car? Is it $20,000? Maybe, right? And that's fine, but once you pay off the $20,000, did we need that car? Is it worth anything when it's over, or is it just a liability that we've assumed and it hasn't really worked for us, right? So some of my friends very lovingly mess with me about my 2012 Honda Civic that I still drive. It's got 128,000 miles on it, and I'm gonna drive it till the wheels fall off, or until it needs, like, you know, major maintenance. But that Honda costs me nothing every single month. And so if we were to say, you know, it's time to go get a car, if we're going to assume a $400 or $500 payment, I need to make sure that that $400 payment on the income statement is not at long-term odds with my balance sheet. Does that make sense? Anne has a question.
I do. So have you, in your long-term plans to build an income stream, have you been purchasing real estate that is investment income generating real estate, or are you wholesaling real estate? How does your real estate tie in with your plan specifically?
We're getting there. We're getting there. I promise.
Okay.
So the next big idea, any other questions so far on that? Because I really want to help introduce the idea of a balance sheet, that your entire life is a balance sheet. If you're permanently fixed in an income statement mindset, you won't ever save enough money so that you can stop working. So I want us to think about our financial decisions in terms of total assets minus total liabilities and what is actually left over, which is called your net wealth. That's what I want to push us towards. Okay. So when Andy and I did some planning last year, I was getting a little bit tired of, I guess, only building people's wealth through real estate for other people, like for my clients. There was one particular moment last year where I had sold in a townhome community twice, and a third unit came up, and I was pushing it to my investors and they wouldn't buy it. And I was like, this is such a great deal. Why won't you buy it? And then I kind of like popped up and I was like, why don't I buy it? And so that's really what kicked off the conversation for us getting pre-approved with the lender and really putting our toe into real estate. So at this moment, we own 3 homes. We own the townhome, which is the first investment property. We kept our primary residence that we moved out of, and then we moved into our primary residence. So we have 2 income producing properties and then the place that we live. But none of those things came quickly. It just felt like it came kind of hard and fast, but it was a long-term process for us to really decide to put our time and effort into that space. But before we were even able to say, let's go invest in real estate, we had to have one big major thing, which is called filed tax returns, right? Who on this call works with investors? Investor clients? Okay, lots of people. All right. So if you work with investor clients, you know that any lender is going to require 2 years of filed tax returns. and those 2 years of filed tax returns had better show a positive income. That those 2 years of tax returns had better also support the primary residence that you live in, any debt that you have, like a car, credit cards, or student loans, and it's got to help support whatever investment property you want to take on, right? And so again, getting us out of a short-term mindset, which a lot of tax accountants put people into. A lot of times tax accountants say, hey, my number one job is to get your tax liability down to zero. And the best way to do that is for us to reduce your income down to zero. That's in direct conflict with you wanting to potentially build your own wealth through real estate. Does that make sense to people? So if you have an investor client and the investor client says, yeah, we flipped all this property and we made all this money, but we tried to do a paper loss year over year, where we tried to do a paper loss where we wrote off this bad contractor, and we wrote off this and we wrote off that, and we tried to get our profit down to zero, or we got it down to be negative. Guess what? The lender says, we're not lending to you. You're not credit worthy because you ran a loss last year. And so tax accountants that believe that their only job is to reduce your tax liability to zero are the bane of your existence if you want to invest in real estate, and really if you want to build wealth, right? So that's the first part of this tax discussion that I really want you to consider, is that it is okay to pay the IRS. It's okay to pay the IRS because you have got to be able to show an income in order for you to build your portfolio, which is what your stated goal is, right? If I want to retire and all I've done is write off my income, I have nothing left over because I probably had to spend that income, right? And that's really not the goal. The goal of this entire real estate discussion, the whole reason that all of us are at Keller Williams Premier on repeat, is to build a business that funds your truly perfect life. And I would venture a guess that your truly perfect life is not one where you can't afford to buy the things that you say that you want to do, or you can't afford to buy the things that you say that you want to invest in, or that you can't afford to stop working. So Andy and I pay the IRS every year. We, in my opinion, pay too much, but I am happy to continue paying the IRS because it means that I have an income to support it. Okay, so are y'all tracking on this so far? One of the things that hurts my heart as a I guess financially minded sort of person is when I hear agents say, hey, I just got this $2.99 monthly subscription to this service for, giving me this 75-piece listing kit with magnets and flyers and postcards and whatever, and it's only $2.99, and we just need one closing to pay for it. Okay, well that's $3,600 for the year. And then they say, oh yeah, and then I got this dialer system and it only costs $99 a month. Okay, that's another $1,200 a year. And then on and on it goes, right? And they say, oh, you only need one closing to cover it. Well, with that mentality, you would need, 12 closings to cover all of the expenses that you've opted into. And they say, oh, well, it's a tax write-off. So what? You ultimately, at the end of the year, have spent every single dollar that you made and you've kept nothing for yourself. And I don't know about you, but this job is entirely too hard to work for free, essentially, right? This job's too hard. So I want to encourage you all to get yourself out of that mindset. The goal of business is to turn a profit. It is to be profitable. It is to have money left over, right? So I'm going to show you an income statement because I think this gets a little abstract. These are not my actual figures for last year, but I do want to at least do this for illustrative purposes. So let me share my screen. Can y'all see it? Can y'all see this income statement? Yes. Okay. All right. So this is a template that I work off of. People will often ask me if I run things through QuickBooks or if I've got some fancy system or how I manage how I manage the business, and really the answer is on this very advanced Excel spreadsheet. That was sarcasm in case anyone who didn't catch that. Okay, so for the last 5 years, I've been running my business off of the spreadsheet. So at the very top, now again, this is the income statement. This is not our net wealth. This is just for the year, for the business. I'm going to track all of the commission revenue that I get. I'm going to track all of the referral income that I might get. I'm going to track all of the profit sharing that I might get. And I'm going to subtract out the rebates that I give back to a buyer client. So as a business practice, I'll offer a credit to buyers that close who are teachers as a thank you for their service. So I cover essentially the cost of their inspection fee. But as a practice, I don't rebate my commission to anybody. People would say, do you want, well, I'm doing you a favor because I'm letting you be my agent. Bye. I don't rebate commission. But if you were to give credits to buyers or whatever, that rebate comes, you can subtract it right off your commission. Okay. So let's say, for argument's sake, that the income that I showed for the year was $231,000. That's a pretty good income, right? But we are all self-employed, which means we are all responsible for paying our agent bills, our office bills. So then we're responsible for advertising, for photography, for staging. We're responsible for deducting our mileage allowances if we have that. We have accounting fees, dues, legal expenses, professional fees. You may pay for a super key. You may pay office rent. You may pay errors and omissions insurance. You may pay contract labor. So I pay for the help of contractors. That contract labor is significant, right? It's a portion of the business that goes towards me getting the number of deals closed for the number of people that we're helping. So that's a deductible expense if it's contract labor. Then you've got your cell phone, and you've got your home office, and you've got your license renewal fees and your copies, and you pay showing time, and you might do coaching, you might buy gifts, and on it goes, right? So reasonably, let's say that when we tally all of those things up for labor, for supplies, for gifts, for marketing, for advertising, everything, let's say that I spent $65,000 for the year. That means that roughly my business income for the year was $166,000, roughly. Now, if I were, let's say, less business minded and more like, let's get my money down to zero, I could take this $231,000 and I could blow it all over town. I could pay everybody for everything. I could hire all the admin help that I thought I wanted. I could do it, you know, for free. I could essentially reduce my taxable income where my expenses were, let's say, $170,000, maybe $100,000 more. But if I had $231,000 and then I spent $170 of it, then I would be left with about $66,000 for the year, right? And if we're talking about being able to build our wealth through real estate, and we want to be able to go file our tax returns and then move it on down the road and invest for ourselves, $66,000 for the year to show the lender is really not enough for you to probably be able to do what you want to do. And that's really where I see people get caught up. Do you have questions on that so far? Go ahead.
I just have one question. This looks an awful lot like the spreadsheets that I use at home for my own budgeting and savings, tucking away money. I got up this morning getting ready to build exactly this spreadsheet for my business. I'm 3 weeks with Keller Williams. And so I would give my left arm if you would just email this spreadsheet to me. It would save me so many hours.
Sure. I can email out a blanked out version of this.
So great.
Again,
so great.
This is not my actual income. This is just.
I know. but it's a terrific format. I'm used, it looks exactly like what I do at home. So I would love to have it.
What I'll do is I'll send it to Madeline, and then I think Madeline might be able to blast it out to the Market Center, so that way y'all don't have to.
Thank you.
Yeah, you're welcome. So that way y'all don't have to do that. And really, this is a modified spreadsheet that came from my sponsor, who y'all may not know. Monty Wall is the person who brought me into Keller Williams, and she was our on-site broker for a good period of time. So this is really just a modified version. Monty herself is also a certified nerd bird, so she's also a CPA. So, anyways, we will send that out to Madeline.
Thank you so much. It really is beautiful.
Oh yeah, you're welcome. So the reason I wanted to show this to you is that I talked to very, very tenured, very capable, very intelligent people that in my opinion, fall victim to very bad advice from tax accountants who believe that their only job is to take this $231,000 and to reduce it to zero. And while it's great every single year to not have to pay the IRS, something around $34,000, which I have as estimated right here. While it's great to not pay the IRS $134,000, I sure would like to have $132,000 left over out of my 166. Because now I can go show an income that's healthy enough, and I probably kept a lot of that cash, and I can go show a lender an income on a filed tax return that really enables me to build my own wealth through real estate. Questions or thoughts on that so far? How is this different from what you may or may not have seen before?
I think it's amazing. Thank you so much for that. I mean, so much of us run from our numbers, especially when we don't have the gift and skills that you and some of the other backgrounds on the agents with the CPA mind. So this is awesome. So thank you for doing this.
You're very welcome. And I can't imagine. Self-employment is a very rewarding position, and it is a very steep climb. And to give away the very hard-fought dollars that you have is very hurtful when I hear people say that they did it in the name of reducing their tax liability only. Okay. So that doesn't mean that we don't personally utilize ways to reduce our tax liability beyond these expenses that you see in the spreadsheet here, because we do. I probably wrote off somewhere around $75,000 last year, but I paid taxes on a fat chunk. It was a bigger chunk than I thought it was going to be. So I owed the IRS a lot more money this year than I thought it was going to. Well, while that hurts, it's a real blessing, because that means that I was able to produce a higher income, and I'm grateful for that, right?
The one thing, Carolyn, that thank you for this, because I don't look at numbers like you and Jeff do, but once you start looking at something like this and really tracking it, you really realize how carelessly I spend, and it's just so amazing. So again, that's another great thing to look at this. Thank you.
You're very welcome. It's a long-running joke. If Raquel were on this call, she would make fun of me, because this is my bag of carrots that I ate for lunch today. But
I have another question.
It's an ongoing joke, but really, like, I like to have fun. I like to spend some money, but I am personally probably more frugal than the average bear. So this is not like a bright line to say, only spend 25% of your income. I technically am outside of the MREA model, the Millionaire Real Estate Agent model. As a person who produced $10 million in volume last year, if I was following the model exactly, I would have kept somewhere around $120,000 in net income. So I have made a personal choice to spend less growing the business. Honestly, I've made a personal choice to grow through referral instead of growing heavily through marketing and advertising. If I leaned more into spending on marketing and advertising, I would grow the business faster than I have. But the personal goals that Andy and I have right now are a little more in line with us keeping a little more cash. So that's how I've chosen to run it. So this is not supposed to be a bright line. so much as it is just to be an awareness point for you, to say, if I do have goals, how do I start getting there? Okay. So what was your question?
Well, you kind of answered it, because I was going to kind of compare this once again to what I do in my personal world. Is I have a percentage of my income that I'm allowed to spend on dining, entertainment, whatever. And I know the Millionaire Real Estate is so aggressive in marketing dollars and, staffing. Let's get your staff rolling. I'm just not ready. I'm not ready. Maybe I haven't built up the faith yet, right?
I mean, and it takes time to get there, right?
Yeah. So do you have a particular percentage set up for yourself, a budget that's working on how much dollars you're placing in what buckets?
My budget lives in my brain. Sorry.
Okay.
Sorry.
I have to put mine on spreadsheet, or I won't stick to it.
No, generally I run about a 70% profitable business every year. Somewhere between 70 and 75% every year.
Good enough. That's all I needed to know. Thank you.
So that's me. And that's in no way a recommendation. Other thoughts and questions so far? Okay, so let's transition this. One other big piece that I want to touch on. All of these are business deductible expenses that reduce your taxable income. But one thing, and if you've been on our mastermind calls, this may be redundant, so forgive me. But one thing I want to introduce you to is the idea of a SEP IRA. A SEP IRA is it's really just a 401k version for self-employed people. Let's look at the limits. Okay, so if you have a 401k, if you came from a W-2 job, a W-2 job usually comes with the option to contribute into a 401k, which is an IRS allowed savings vehicle. So if you made $60,000 as a W-2 employee, you could contribute up to $19,000 to your 401k last year. So what that means is that you would have made $60,000. You would have, let's say you were super aggressive and you maxed out that contribution. If you put all $19,000 into the 401k, your taxable income in the eyes of the IRS is now only $41,000. So that is a massive tax reducing or tax deduction that you can take as a W-2 employee. And when I first got into real estate, I thought, oh no, the 401k protection is going away. I don't have that ability to write off income into a retirement savings account. But I was quick to talk to my own tax accountant. And so what I did is I called him and I said, what do we do? And he said, well, great news. Because you are self-employed, you have access now to something called a SEP IRA, which is the #1 way to write off your income, where you're choosing to pay yourself. You are choosing to pay your future self. This is really talking about going into the balance sheet side of the statement, not the income statement, but we're taking a large chunk of our annual earnings, our net income that's left over, and we're shifting it over into the balance sheet, because the balance sheet, remember, is the cumulative effect of every single year that you've chosen to work and live, right? So I can take a large chunk of my current year income and throw it onto my balance sheet and hide it essentially from the IRS. So if we go back to this example here, if I had $166,000 in net income before taxes, the math on this, you need to talk to a tax accountant, but roughly you can contribute about 20-ish% of whatever your net income is to a SEP IRA. And so what that means is that, and you need to talk to your tax accountant for the exact numbers, but just for argument's sake, let's say if it's about 20%, if I had $166,000 in business income, I could put roughly $32,000 into a SEP IRA, thereby reducing my taxable income to about 130,000. So now instead of me paying taxes on 166, I paid myself a huge chunk of money into my SEP IRA, and now I'm paying taxes on 132. So my overall tax liability just reduced. But instead of me blowing funds on paying for a Vulcan dialer, paying for some kind of subscription that I never use, or subscribing to whatever that costs just $500 a month, and you do that over and over again, I've now chosen to pay myself, and it's still a tax deduction. Does that make sense? If you are only working with a tax accountant who says, hey, let's write everything off, and this number, let's say I spent $175,000 or $165,000 instead of only spending $65,000, now I can only contribute, let's say 20-ish% of my $66,000. So now I'm limited to contributing roughly $12,000-ish into my SEP IRA. And when I think about that, it kind of makes my stomach hurt, because I've just given away the equivalent of $20,000 to other people in the name of a tax write-off. And if it didn't really benefit your business, what was the point, right? And so my number one goal for agents is to help themselves see that you can actually build an incredibly profitable lifestyle for yourself and build an incredibly comfortable portfolio year after year after year if you choose to do the things that are just a little bit different than the average advice that you might receive. Does that make sense?
It does. And Carolyn, I think one of the things, first of all, thank you. And one of the things that's really important is that dialogue with your CPA. Hopefully it's not just a tax accountant, but rather a certified public accountant that can give you advice, right? And it's really important that as you're meeting with them, that you're setting the expectation of what your intention is, which is to build wealth at the most optimal tax rate possible. Because you're right, there are some tax accountants that are simply going to be very short-term focused, but hopefully, again, as you're setting out your expectations and your goals, it's make sure that you're communicating that so that they can better serve you.
That's right. That's right. So we interviewed several tax accountants before we picked one. And yeah, if we're getting into the lingo, he is a CPA, and not all CPAs are created equal. You're looking for someone probably who has a consulting approach, who really wants to hear about what your goals are for the year, who really wants to hear about what your goals are long term, and wants to plan to help you do that. Your CPA might be somebody that you want to call at a couple of major points in the year. Especially if you're self-employed, to see if you're contributing enough for the year, to see if you should make a SEP IRA payment in the middle of the year or contribution in the middle of the year, to see if you're going to be eligible for things like a Roth IRA. You know, if you can contribute to both a SEP IRA because that's pre-tax, so it reduces my taxable income in that example that I just gave you, and you can also contribute money to a Roth IRA if your income limits come in under the maximum for the year. So just to go back to the screen sharing really quick, I do want to put a bow on this. So for 2020, I just Googled SEP IRA limits. It looks like the maximum is going to be the lesser of 25% of my adjusted gross income-ish. And go to your tax accountant for figuring out what that is, but it's there and about your taxable income. So about 25% of your net income, but really about 20% of your net income. So the lesser of 20% of your net income, or $57,000. So if your net income was, let's say, $350,000, 20-ish% of that, 70,000, you would hit the maximum there at $57,000 that you could squirrel away into a very similar 401k equivalent as a self-employed person. And that to me is the single largest gift that you can have, that you can give yourself as a self-employed person. It's a steep uphill climb and you might as well pay yourself, right? The Roth IRA is something separate from that. The Roth IRA is an after-tax savings vehicle. So you get no additional tax write-offs for having contributed to a Roth IRA, but the beauty of a Roth IRA is that every single dollar that you save is tax-free when you withdraw it at the age of 59 and a half or 60 years old. So So the SEP IRA income or your 401k income is pre-tax income, meaning you just lop it off the top and you don't pay tax on that income every single year. But when it comes time for you to withdraw it, it is subject to the income that you withdraw when you're 59 and a half or 60 years old. It is subject to income tax at that time. A Roth IRA is your after-tax dollars, and it just means that you're contributing your own savings into this gift that the IRS came up with in the 90s called a Roth IRA, where that money can grow tax-free every single year, and that when you withdraw it, it is also tax-free. Okay. So if I were getting started in this conversation of wealth building, those would be the very first things that I would explore. Yes.
I have so many questions. I love the idea of a SEP IRA for self-employed folks. And I wonder if you have a deadline that you can make a lump sum contribution up to that $57,000 or 20%
So
up to
I
December.
don't want to get too far into the weeds with the taxable part of this discussion, but you should lean on your tax accountant for that. Generally speaking, for both the Roth IRA and for the SEP IRA, you have until the tax filing deadline of that year to make those contributions.
Excellent.
So you could make small contributions throughout the year, and then true it up or gross it up to whatever the total needs to be when it comes time to file your taxes. But on an individual basis, it gets highly muddied. So I want to just give you kind of a high level overview, because if you're married filing jointly, that's different. If your husband's income is factored in, that's different, and on it goes. If you have different corporate structures, it can all change. So I'm just giving you guys some ideas, and y'all can really lean on your tax accountant from there. Now, with y'all's permission, I'm going to stop sharing screen here, and I'd like to shift the conversation back to the real estate part of the building wealth. So I think we've kind of covered why we don't write off our taxes to zero, right? We've covered how to reduce your taxes by paying yourself, right? And now we're going to talk about, with the money that's left over after you've paid the tax accountant and after you've paid your SEP IRA and your Roth IRA, what else can you do with it? And the natural answer for Andy and I was for us to invest in real estate. Okay, so this is something that we had wanted to do for a while, but I felt personally very strongly that I wanted to do it when we had available cash, while we made sure every year to maximize the contributions to the SEP and the contributions to the Roth. So those two every single year, to me, are non-negotiable. Non-negotiable. We max out the SEP IRA. He maxes out his 401k. If we're eligible in a given year, we max out the Roth IRA. Then we look at the rest of the cash and say, what do we do with it? So real estate. If you are a real estate investor, you need to get pre-approved with your 2 years of filed tax returns that show that you have an income that supports all of your recurring debts, your debt to income ratios. So that would be your own house, your own primary residence, your own car, if it's got debt on it, your student loans and your credit card payments, right? Those are the things that are going to show up on your credit report or your DTI. You then have to have income. You have to have additional income that would support the additional debt that you're looking at taking on if you're going to invest in real estate by using a loan. Okay, so that's why it's so important not to write off that income to zero. Now, I've put together an investor series that is online. So if y'all want to utilize that, you're more than welcome to. You can Google Carolyn Bauerschlag Investor Series. I put together a 5-part series for my investors, and y'all are more than welcome to lean into that as well, where I go into deep dive. So it's about 15 minutes, 5 videos, 75 minutes of content. But the big thing to know, and people don't necessarily realize this, is that let's say you think that you're going to buy a single story 3-bed 2-bath house, and that income is going to generate roughly $1,600 a month in rental income. The lending laws set forth by Fannie Mae and Freddie Mac allow for, in the debt to income ratio, for you to account for roughly 75% of your future rent to be counterbalanced against the debt that you're assuming, right? So you're not just talking, like, let's say your principal, taxes, insurance, and interest on the investment property that you're assuming is roughly $1,100 a month. And we think that our future rents are going to be roughly $1,600 a month. Fannie Mae says that you can count $1,200 a month of revenue against your $1,100 a month in recurring debt. So you are actually at a net positive when you're getting pre-approved. You're not at a net negative, you're at a net positive on your debt to income ratio to the tune of about $100 a month. So really in the eyes of the lender, you endeavoring to do a real estate investment purchase is actually a net positive. Pretty cool, huh? Did anyone know that? Mary says yes. Okay, so that's a really big part of this conversation. When I first started doing this for my investors, I didn't know that was a thing. I actually thought that most of my people were just insanely rich, and then I had no idea that I myself would never be able to invest in real estate the way that they were. But it turns out the Fannie Mae, Freddie Mac lending laws are in your favor. So what the lenders also stipulate is that if you're going to do an investment property that you are not occupying, you have to put down a minimum of 20%. So that means that you would have had to have saved all of your monthly income streams and really saved up a large chunk. So what we're talking about probably is somewhere around $40,000 to $45,000 if we're looking at a $200,000 purchase price. So we need to have $40,000 to $50,000 ready to roll that we can drop on an investment property. There's no FHA, there's no VA, there's no 5%, 10%, 15% conventional on a single family second purchase. So there's some cool workarounds, like if you were to buy a duplex and you were going to occupy one side of it, then you could utilize those other loan products. But for the purposes of saying I just want a second property that I'm not going to live in, it's 20% down. Okay. One of the things that surprises my real estate clients is that they believe that cash flow is what is going to make them rich, the monthly cash flow. So when I tell them that in this state of Texas, we consider a positive monthly cash flow like a really good thing to be somewhere between $200 to $300, you could knock them over with a feather, because they think that they're supposed to be generating, $700, $800, or $1,000 a month in positive cash. And if we lived in non-property tax states, like my beloved cousin who's up in Bend, Oregon, which is a second vacation home kind of town, their property tax bills are like $800 for the year. And so he's like, oh my gosh, you guys, I can't believe that people do real estate investment and you're only getting a couple $100, because they are getting $800, $900, $1,000 a month in positive cash flow. So if you are thinking that you're going to do real estate investment and it's going to generate some massive income stream for you on cash flow alone, you're going to be surprised. What I like to push back on for everyone is the very idea that we coach all of our clients around, which is that real estate appreciates every single year. Okay, so if we stick to our $200,000 purchase price example, National Association of Realtors tells us that the average home appreciates somewhere between 3 to 5% every single year, which means that in a given year, our $200,000 asset is going to be worth $206 to $210, right, at the end of that year. That's a pretty cool way to make $5,000 to $10,000 in a year, right? I thought that was cool, right? So that's 3 to 5% of appreciation right there. So you've just got something that for the benefit of you owning it, just choosing to tolerate the risk of having a tenant, you've just made $6,000 to $10,000 on that $200,000 asset. Now let's say that asset generated, like I said before, somewhere between $200 and $300 a month. That asset is generated somewhere between $2,400 and $3,600 in a year. So now our total is up to somewhere around $8,400 to $13,600 in a given year, which is starting to sound pretty good, right? It's starting to feel like it's probably worth your time. But those two things by themselves are still not even the whole picture. The one thing that people always forget, myself included, is the debt reduction part of this conversation. So when you have a tenant in a property that you own, the tenant is effectively paying your mortgage. And all of us are familiar with how a 30-year mortgage works. It is called amortized debt, which means that your payment stays the same. The principal and interest stays the same every single month, but the bank is savvy and the bank always wins. So they load the majority of the debt into the back end of the deal. So your first payment is like almost entirely interest, and it stays that way for the first 10 years or so, right? So if we say that it's a 30-year loan, it's unfair to say that your debt is being reduced 3 1/3% a year, because the bank is collecting the majority of their interest on the front end. So let's say that the tenant pays your monthly note every single year, and they brought your total debt balance of, let's say on this $200,000 example, they brought your total debt balance down from $160,000 to, let's say, $155,000 in that first year. Let's say they brought it down by about $5,000. That $5,000, or let's say it was $4,000, we're probably talking about somewhere between 1.5 to 2 percentage points in the early years of your loan that your debt is being reduced. And if we remember that on the balance sheet side of this equation, the whole net wealth conversation, our total assets minus our total debt is our total equity, our total net wealth. So someone else is paying the debt for me. So my liabilities are reducing just because someone else is staying in the house. So if I add up the $4,000 plus my $13,600 plus my $13,600, or on the low end, my $8,400, we're talking about somewhere between a 5.5% to 9% return on that $200,000 asset every single year. And that to me makes a whole lot of sense. And that to me makes it a very compelling reason to not reduce our debt to a place where we cannot afford to do it, or not to reduce our income to a place where we can't afford to do that very thing. So what we did ourselves is we had some underutilized cash. I was afraid to invest because I was afraid of assuming more debt, because I couldn't get my head around the fact that the tenant was paying the debt for me. I ultimately felt fully responsible for the full weight of that debt. And really, that didn't go away because coronavirus hit and the CARES Act was passed, and they said if your tenants can't pay you, you can't do anything about it. So that was very scary because we didn't do any of this math on us floating 3 mortgages indefinitely. But God is good, and our tenants are fine, and they were able to pay. So we are only currently responsible for 1 mortgage. But in general, you are not, in a non-coronavirus year, you are not responsible for the full weight of the debt that you are assuming. Ultimately, the tenant is paying that debt for you. Okay, so you do have to have some risk tolerance. You do have to be able to say, like I did yesterday, I just spent $285 on plumbing, which is the sum total of my net profit monthly on that unit. So you do have to have a tolerance for that, and just kind of be okay with the fact that the real compelling reason in Texas to be a real estate investor is for the capital appreciation long term, right? So we put our toe in this water. We closed on September 20th of 2019. We got a tenant into that place. We listed it and had multiple applications fairly quickly. We got a tenant that wanted to be there for about 1.5 years. As fate would have it, a house came up for sale that Andy and I had actually seen and pointed at and mooned over ourselves several months prior. We had no idea it was coming on the market. We made the decision to buy that house. And I, Miss Clinical over here, got super emotional about the idea of selling our current primary residence, the one that we had owned. And I just couldn't emotionally part with it. So we made the decision to leave our equity untouched, and we decided to keep our old primary residence and to put a tenant in there. And because our cost basis was so much older, you know, we had bought that house 7 years prior, 6.5 years prior, our carrying costs were significantly lower than today's market prices. So our monthly cash flow on that particular house was a lot better. So the question to ask yourself is, you know, if you're thinking about moving yourself, or let's say you're not totally thrilled with your house, but you think that you could qualify for a second mortgage, ask yourself a very important question. Do I already own an asset that could be income producing? That's a very, very low risk way for you to dip your toe into the investment water. If you simply choose to move out of your current home, buy your next one, and then turn around and lease your other property. So that's how we went from owning one home in 2019 to owning 3 homes at the end of 2019. It's been a stressful ride. I'm not going to sit here and lie to you guys about that. But it's been one that I can say 8 months into the year that we're very grateful for having done. So I do have about 20 minutes for questions. So I'd love to open the floor to y'all and just hear what y'all have to say.
Hey, Carolyn, thank you again. I'm gonna add one thing because I'm gonna jump off, and we have a Wealth series every Wednesday at 3 o'clock from KW International with Jay and all them. So I wanted to tell you that one thing that Jordan Davis told me, I love the idea, what you just said, when you own your own property and you put down 3.5%, 5%, turning that into a rental. What she did is she looks for doors and houses that have some equity. She writes an offer. If it's 200,000 and the seller accepts it, she makes her commission for 10%. And she uses that as part of her closing cost and down payment because it's her income. So she closed on one of those. So that's another nugget that no one had ever shared with me. And I said, wow, because we're like you, we're looking for our third one right now. We're buying in Arizona because our property taxes are really low. So it's just a state you can look at. Yeah. All right. Awesome. I appreciate you guys. But yeah, if you can find a deal, the house has to appraise at 220, she said, but she offered them 200. They took it. She got 20,000 in commission and she used it towards her fees. So
super smart.
Have a great day. Thank you, Carolyn.
Bye. Other thoughts, other questions? Someone asked here in the comments, do I pay somebody to manage the property for me? No, I do not. They charge about 10% of your monthly rent. If you had a ton of them, I suppose that's okay, but right now I don't have a ton of them, and I would say it's a false start. It's usually a little bit difficult for the first month or two that the tenant's in there, but after that it gets a lot easier.
Yeah, and I just want to clarify something. You can manage your own properties as a real estate agent, but you cannot manage someone else's properties. So you can't property manage something that you don't own yourself.
Very good to know. Didn't know that. What else? Anybody thinking about buying an investment property? Brian?
Yes.
Mary? Okay. What are you guys thinking about?
I've got to finish my personal home refi first.
Yeah, we just did our refi. Oh, I'm sorry, go ahead, Brian.
I was going to say, I don't know if you guys have heard about this, but Kelly Rogers' team over at Movement Mortgage apparently has a 15% investment product now.
A 15?
Said the interest rates are just a smidge higher, but they can do it with 15 down. So,
wow.
Just in case anyone's interested.
Yeah, you know, and if they've got a loan product that's not Fannie Mae, Freddie Mac, right? Something that's not a government-backed loan. You know, smaller lenders can do whatever the heck they want. What else? Brian also asked, I saw these comments from earlier. Do you max out the SEP IRA or the Roth first or simultaneously. To me, the Roth would be first, simply because that's tax-free income that you can withdraw when you're 59 and a half. So because it's tax-free and it can grow tax-free, that to me would be first. But that's like 1A, and then 1B would be the maxing out the SEP IRA. I really would do both. I wouldn't do one instead of the other. So if you've got like, $5,000, I would probably put a heavier weight towards doing some to the Roth, but I certainly would start a SEP IRA.
I got a couple more questions for you regarding those. One, the SEP IRA that we're going to pay taxes on when we take it out, is the entire amount taxable or just the initial amount that we deposited? Meaning, are the earnings taxable as well?
The earnings are taxable as well, as the way that I understand it, because you never paid tax on it in a given year. You never paid tax on it. And if I contribute $20,000 in 2019, that was money that I did not pay tax on in 2019. So the tax man comes and they say, yo, give me my money. So it's usually taxed as ordinary income.
That wasn't the answer I was hoping for. And my second question is, what does your investment, just you personally, what does your investment contribution on a per transaction basis look like? Are you putting 10%, 15?
Yeah, no, that's a great question. So the methodology that's worked for us personally, Andy, my husband, has a very steady W-2 income. So we as a household live off of his income. We made a decision to not kind of factor in my income into our living. And that the math on that is with the tenants paying our other two investment properties, like those rents being paid, right? So the viewpoint for my income has been very aggressive savings and very aggressive debt reduction, truly. Like, and by debt I mean mortgage payments. Like we contribute additional income. So right now, when an income check comes through or business revenue comes in for me, I know that my effective tax rate for the last several years has been about 21 or 22%. So I know about a fifth of that is going to go into taxes. I know that roughly I'm going to contribute. I know that I'm going to have to contribute probably somewhere around, not quite 20% because it's my business revenue, but let's call it about 10% of my revenue, my gross commission income checks. About 10 to 15% of that is going to be attributable towards some kind of retirement savings, because that's the business revenue. It's not minus all of my expenses. So my methodology is very much not in line with these profit first books because of my financial background. I don't need to have 8 different bank accounts and to take one check and divide it up 8 different ways, because that would actually stress me out worse. But it's a great place to start if you don't have a background or a comfort level in doing that. So what we do is we kind of know that Andy's income covers our living expenses, and that we utilize my checks that come through into a common bank account. And when that bank account gets to a certain level, okay, it's time to disperse X amount into the SEP IRA. Okay, it's time to go refi the house. Okay, it's time to make a large contribution to my quarterly taxes, right? So without fail, every single year, the tax man gets paid quarterly on April 15th, June 15th, September 15th, and on January 15th. So those are the quarterly payments that we'll do gross big fat chunks of. But then the SEP IRA contributions are sweeps when the bank account gets high enough. In a perfect world, I would say, okay, my last 2-year average of SEP IRA contributions is X. So then I would take X and divide it by 12 and sweep 1/12 of that, trailing average into a bank account or into the SEP IRA. Because really, like, if you want to get technical with it, you should not take $20,000 and invest it in one fund on one day. You should, chunk it down.
Okay, perfect.
Yeah. So because my income is so non-standard, we spend it almost in the same way that it comes in that we do it in batches.
I do on a per transaction basis. It's just one of the things that cuts. But I'm the primary income earner in the house, so.
Sure.
Yeah. So that was my question.
Sure. Was that helpful? Did I answer it?
Yes, ma'am.
Okay, good. Angeles asked if we use a home warranty company. I did buy a home warranty for our investment property, and I wrote it into the lease. The tenant would pay the trip charge for any broken warranted item. So I kind of wanted the tenant to have a little bit of skin in the game. So I don't want to hear about every time there's an issue, but I do want for someone to come out and take care of, like if they've got some problems, like if you're flushing stuff down the toilet that you shouldn't be flushing, or you're running an entire like load of food through the dishwasher, like I don't want to get the phone call every time, right? So we did put a home warranty on the property. Tenant pays the trip charge.
I have a question.
Yes.
What are other things that you put into your investment properties? Like, I'm planning on putting our house for lease, our very first home, and we're looking into buying our second one. So yes.
That's awesome.
And it's kind of the same start that we're kind of doing in the same sense that my husband is the first one with the W-2, so we have more like a steady, and then my commission will be more of like the secondary investment, and it helps us out putting into investment. And the reason why I asked is because we are now getting ready to finish up kind of getting the outside of the house landscaping very leasing friendly, so there's not a lot of weeds and craziness, and we also have a pool. So I know with the service, with the resident service, some of those are added into it.
Yep.
Which we have used it before. What other things do you recommend to have for
an umbrella liability policy? If you've got that pool, go get yourself a fat chunk of insurance on liability.
Okay.
Like a huge liability policy. You don't want any accidental death, drowning, any of that. You don't want them to sue you.
Correct.
So that would be step one. We carry liability insurance, an umbrella policy for us. As individuals, we put flood insurance on all of our homes, just because I don't trust Houston. We pay lawn maintenance on both homes. On the townhome, that was included in the HOA. On our current home, our former primary residence, we decided to keep the service because I've seen the homes where the service has not been kept, and the yards look really bad. And if yards dry out in Texas, it'll crack your slab, you know. Yeah. So you know, it's worth the $600 a year, $800 a year to me to make sure that I don't have an $8,000 slab problem in the future. Okay. So my philosophy on monthly cash flow from the property is probably very different from your average investor. The way I see the monthly cash flow is just to kind of pay for the stuff that breaks or that needs to be taken care of, such that my capital appreciation long term is okay.
Which is kind of what we saw too, because this house is a much older home. It was our first home. I'm in the same position that I kind of didn't want to sell it, although if we were selling it, since we bought it 5 years ago, it will be a great return right now. But I kind of feel like we want to keep it because it has a sentimental value and it's going to appreciate even more anyways.
Yeah.
So yeah, for us, it will be the same thing, just using that extra cash or whatnot towards the house to continue to enhance it. Another question I had was, I noticed that you said you, in your case, you send your quarterly payments for your taxes.
Yep.
Is there, when you do those, do you also do, and I don't know if you might have said it, your Roth and your kind of like your savings wise, your 401k?
Yeah. So that was kind of Brian's big question. So I always pay the taxes quarterly, and every single self-employed person had better be doing the same, or else you're going to pay penalties at the end of the year. But for savings, I kind of batch it because my income comes in batches. So I'll make contributions kind of in large chunks. And what I was saying to Brian was, in a perfect world, I would kind of look at my 2-year average for what I've contributed to a SEP IRA, divide that by 12 and contribute it monthly. That's probably what I should be doing and haven't done.
Okay,
No.
I might have missed one thing. You said the Roth IRA and the SEP IRA. I know that they're two different ones, and I kind of get it. I'm gonna have to read a little bit more about it. But the SEP IRA, do you make those payments as well quarterly, or you do it once a year?
It's really just up to you on how you want to do it. It's
All
up to
right.
you.
Thank you.
Best practice in general is to do dollar cost averaging, where you're submitting a little bit every month so that you're not investing that money all on one day. But it's just kind of, it's on a case by case basis, really. So that's how I would handle it. Just
Thank
do
you.
what's best, but it would be best to avoid at the end of the year saying, oh gosh, you know, I have to contribute $25,000 in my SEP IRA and $5,500 in my Roth IRA. Where's my $30,000? You know, that can hurt. So I would say figure out what works for you and your husband, but don't compromise on it if you can help it. What else? I got 4 more minutes. What can I do for you? Who wants to talk to me? Do you insure the rental property as a second home, vacation home, or rental home? Rental home. Because if something goes sideways, the insurer will not insure you if they felt that your application was not correct. So rental. What else?
I got another question for you real quick.
Yes.
Lenders requiring reserves over and above your 20%. Thoughts?
Like, do they require it?
I've talked to several that are wanting to see some as much as 20% reserves
Yeah.
in,
So
in accounts.
we had reserve conversations, but we bought our stuff before coronavirus. Like, I've worked with a couple of people who are self-employed, who have been self-employed just on their primary purchase. And they are putting people through the paces right now. Like, just
Yep.
insane representation letters. We had to submit 2 CPA letters, you know, to say, I've prepared her taxes, I've prepared it for 3 years. Her line of work is the same. They're like, well, what's this entity who's issuing the 1099? They wanted the paperwork from the 1099. That would be like us trying to buy and the lender insisting on seeing the brokerage's paperwork. Like, that's crazy. It's
Right.
crazy. So but these lenders are very weird right now with self-employment income. So they may be requiring reserves that are higher. I would say that we were not required to show 20% reserves in excess of the 20% down. I'm sure that we were required to show some kind of reserve. I think it might have been like 3 months of like mortgage payments, but not another 20%. Because then why
Yeah,
wouldn't I put down 40%, right? That's insane. I think we had to show like maybe 3, maybe 6 months of.
Okay.
Yeah, but nothing like that, Brian. That I would say is probably reflective of a coronavirus lending environment for self-employed people. That's good to know.
And one of those was Keller Mortgage, by the way.
Oh, good. Yeah, risk averse.
Yeah.
Right?
So,
Risk averse.
right.
What else? Well, I appreciate y'all being on the call with me today. I appreciate leadership for setting this up and for Mary getting me to speak with y'all. I'm going to type into the chat box here the Facebook group that I'd like y'all to join. Get real, get right with personal.
Thank you, Carolyn, for instructing the class. I feel like we all learned something today.
Good. My pleasure.
Yeah, I've missed your calls. I'm glad you're back on it.
Oh yeah. Yeah, no, I'm excited to do it. Go join that Facebook group. I fell off the wagon in July because it was a crazy real estate month, but we have a mastermind, a baby mastermind that started, and we're supposed to do two calls a month. So get your friends to join, y'all hop on, and we'll keep these conversations rolling. Thanks, y'all.
Bye.
Bye.